Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS, an options analytics platform built on top of over 15 years of historical options data. Our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your Trader brokerage account. Today on the show, we're going to talk about valuing your options portfolio. Matt, do you want to share your screen and get us started by going over our positions from last week?
Sure. Thanks, Tyler. All right. So we had an Apple. We did a long put spread and a long call spread right around the money. Apple was 230, and we did a 230 long put spread. We paid 212 for that, and a long call spread. This was 2 weeks ago. I was traveling last week, so we didn't have a show, but we could still take a look at how Apple did with the magic of our trade finder. So our trade finder tool, let me get my drawing tool going too. Our trade finder tool shows how that put did. So at the close, let's see, at the close on October 11th, when it expired, the 230 put on October 11th. So the stock expired at 227, so it was in the money, almost $3, $2.36, and it says 254, but that's just a wide market. So this is actually what it's expiring at. So we made a few bucks on that one, and we still had the Nvidia trade going, and that trade is here. So it's up to 10 today and up $2,090 from when we opened the trade, Tyler.
All right, that's great news.
Yeah, and I think this leads us into how to use this, because the show is about how to value your portfolio. And many people would say, well, it's the mark, right? So it's, and as I just said, on that Apple trade, it's not, the mark isn't always what the true value of a call or put option is. And so what we try to do at ORATS is we try to present theoretical values in order to help not only value your portfolio, but when you're trading, you can check out what the various theoretical values are. You can compare those to your trades, and it helps you in various ways. So what I'd like to point out now is we have really 3 ways to trade. So let's go to our option scanner, because the option scanner has, it's interesting to compare. And we'll just go to Nvidia, and we'll look at a couple of strategies. So I'm in the option scanner. I chose a symbol. I'm going to look at a short put spread and a long. I already have a long call spread. We'll do it for 2 weeks in Nvidia, and we'll check out some of the theoretical values that we are seeing here. So first of all, let's talk about the theoretical values. The distribution theoretical value is what D stands for, and I'll show you what that means. So this particular long call spread is trading about 121, now 122, and the distribution is the way that we value a individual option or a spread that looks at the terminal values, which is this kind of green and red, and the terminal value is the value at expiration at each one of the points in our distribution. So we define a lot of these points, and we go back historically and we look at how many times, for example, Nvidia fell within these ranges. Like Nvidia now is 138. How often did it go up to 140.8? how often did it go up to 143.4, 10.8, or it's hard to see, but percent of the time. So then what we do is we say, well, what is the value at that point? And at expiration, you could see that the value is -84 for that point. So we would multiply the 10.8 times the value at expiration, and then do that for each one of the nodes, add them up, and then you get 127, which we would call the distribution theoretical value. Theoretical because it's not real, and a value because it's one way to look at the value of that spread by looking at what it's valued at each node, and each node has a probability. So the expected value calculation is just multiplying the percentage probability by the value at each point. Does that make sense so far, Tyler?
Yeah, it's a good explanation of the distribution percentage, and we have more explanation on this in our university. I'll send a link in the comments.
Yeah, so you could get there by going to ORATS, and you go to university, and then this will be in that link will be in the comments.
Mm-hmm.
So that's a distribution edge, and that's you'll notice that it's these are all pretty close. It's 126 now. The smooth edge is 124, and the mid market is 124, or excuse me, 124. So 122 at 126, and so it's continuously moving. And as a matter of fact, one neat thing to do is check out the chain. So we'll go to the options chain, and if you have a trade already pulled up in the trade analyzer, it'll automatically go and open it up. It's really convenient, so it's very nice to see. So we could see it that this long call spread is valued, and what the bid-ask spread is. And, you could add a bunch of columns to this, and so I like to see all of them. So I have all of them in there. You can see the volume, the open interest, our forecasted vol, which we'll talk about in a minute, the bid, the ask, implied volatility, and mid, the SMV, so smooth market volatility vol, and that's what we're going to talk about now. So that smooth market volatility is derived by us. So we will draw and maybe I'll just click on one of these. I'll click on that one. So this orange line, you can see it better when you click on it. This orange line is drawing our best fit line through the call and put, call in cyan, put in purple volatilities. So you can see that we're drawing a pretty good line through it. And over 95% of the time we were within the bid-ask spread. So this is one of the hardest things that I've done in my professional career, is to draw this line and to do all the things attached with making a smooth theoretical value. Might seem straightforward, it's anything but, because first thing that you need to do is you need to make sure the calls and puts line up, because you should never have different premiums in the call and the put. Premiums being the extrinsic value. The intrinsic value is just how far in the money the call or put is, but the extrinsic value is what you need to equate to one another, the call and the put. They should never be different with put-call parity. And if they are different, then you have some assumption that is incorrect. An assumption like, is there a dividend? Well, there isn't one in Nvidia, or actually there is one in Nvidia. But is the dividend wrong? Is it hard to borrow? Or is just the overall risk-free interest rate that you're using different from what the market is using? And especially the participants and what they can borrow when they need to short Nvidia, what are they paying? And that will drive that interest rate. So first thing you do is have to line those up. And you do that with a complex process, and we have a residual yield, we call it. And that residual yield, we even slope, because some of the implied interest rates are different at lower strikes than at higher strikes. So that's a little bit more complex than I want to get into, but I just want to mention that we do that. And then again, in the university, we handle a lot more of that information. So the smooth, or the SMV, is what that orange line describes, that volatility, and then using that volatility, we then calculate theoretical values. And as I said, right now and much of the time, the S&P is very close to what the price should be. And often when the price is off, it's often that the price is wrong. Or when I say wrong, it's a wide price that's not really fairly valued. Whereas, when you draw a smooth line through all these strikes, you get a much more rational theoretical value often than when you have a very wide bid-ask spread. Now, is that clear so far?
This brings us back to valuing your portfolio, right? Like, the mark cannot always be trusted is sort of what you're getting at, right? And so we've created this whole process to calculate these different theoretical edges that we derive from the smooth volatility surface.
Exactly. Now, the original example was that Apple at expiration. So at expiration, the option is exercised or not exercised, and it's all intrinsic value, meaning there's no premium left at expiration. There's no time left, therefore there's no time value left, and that theoretical value should have no premium left in it. So that's relatively easy. But we saw that the market, they widen out because often there are large moves near expiration, and market makers, which I used to be one, will make wider markets because they don't want to get picked off with no time left in the trading day when they might not be able to get their hedges off. So they are wide markets, and so you'll want to look at an accurate picture of a smooth or theoretical value in order to get a good picture of what that value is of your position that you have on, whether you're valuing your own position or whether you're valuing a position that you want to get into or not. And the smooth edge does a very good job of that. And so those are two we've covered so far: the distribution edge and the smooth edge. The last one that I want to go over is what we call our forecast. Now, this one's going to be often different, and we want it to be different because we're trying to say, well, we know what the market is valuing these options, but what would we value these options if we want to try to forecast what volatility is and forecast what the slope should be and forecast what the long-term implied volatility is? If you put all those together, and for stocks, you include the forecasted earnings move, then you could make a complete volatility surface, forecast a volatility surface that will give you an indication of what you think based on those criteria, based on historical volatility, which a lot of people will use to figure out what they think the implied should be. And if there's earnings coming up, it's very important to utilize that earnings move. And so we have forecasted earnings move. We have a lot of history on earnings. And then we look at a lot of the long-term implied volatilities. And I'll go to the outlook for this one, Tyler, because when we're thinking about Nvidia and we're thinking about our forecast for the long-term implied volatilities, we'll use Nvidia's closest components, and including Nvidia itself in the regression analysis that we use to come up with a forecast for Nvidia's long-term volatility. So all these things together, and then we build, the trade builder, I think, is a good way to visualize it, because the trade builder does a good job, visualizing the surface. And so in this case, the green is for undervalued, or so it's saying buy. The yellow is for overvalued or sell, and the kind of reddish here, the redder it gets, that's a sell more than the yellow, which is kind of neutral actually. So that's what we talk about when we talk about our forecast, and that's actually very subjective. But when you're trading, you want as many things as you can to look at to get some type of evaluation. Otherwise, you're kind of just trading blind. I mean, I know many people will just go on their Robinhood or whatever and trade, and they don't even know what the smooth value is. All they know is maybe the bid ask, and sometimes they don't even look at the mid price. So very important to get as many looks as you can at a particular trade value to compare against what you're buying or what you're selling. How are we doing so far, Tyler?
Yeah, I mean, you make a good point. I think it's something traders need to be looking at more often. And this is why we've done so much work to create these edges. And the more I trade and the more I work with ORATS, it's so apparent how important it is, especially in thinly traded markets, or these days with SPY and 0 DTE options. Things get really, they fluctuate a lot. Theta decay becomes very important, and there's all these things that all these factors that contribute to the price, and the way that we smooth the whole volatility surface just makes it so easy to see a theoretical price that makes sense.
Right. Yeah. Well said. So then what we do with all that information is we'll bring that and we'll put it into our positions, and we'll be able to then say, okay, well, how fairly valued are these positions? And so you'll see it's the D is the first column, F and S. So a lot of the positions that I have on are in liquid stocks. So all these are very much around. 2 is the biggest one that is off of the 0 theoretical value. So like some of these distribution edges, yeah, they're a little bit off, but for the most part, I'm pretty confident that the valuations that I'm getting are, since they're so close to 0, plus or minus 2, it looks like 3, it covers all of my positions, that the P&Ls that we're seeing, and I could just minimize this and see what the P&Ls are today. The P&Ls look, relatively, trustworthy. So we could see that, okay, those look pretty good. There's some distribution edges and some forecast edges. Those tend to move a bit, but again, if you're looking at how to value your positions, I would be pretty confident with these. Sometimes you'll come in and you'll see something that's just, that's just very far off, that you do not have a confidence in. So that's on the valuation. And another thing that I like to look at is you come in and say, well, let's minimize this again. Why are we losing money in XSP today? Okay, so you say, why am I down $300 today? And often people can't answer that well. So let's take a look. And the first thing that we do is you could see what we call our profit attribution. And I haven't seen anyone else do this way. But the profit attribution, so it's saying, okay, negative $331, where is that coming from? Well, you can see that mostly it's coming from Delta. Some of it's coming from Vega. Some of it's coming from Gamma. Some of it's coming from a theoretical mark. Only $4 is unknown. That doesn't work out. And the current mark, again, this mark is kind of our theoretical versus the smoothing. So that's very small. But we should have made $177 on theta, and the slope, or how the puts relate to the calls, we should have made money on. But we lost so much money on Delta that we're down today, and that's why. So Delta, clearly we came in short in this paper trading, and the stock's up. So that's a good way to tell where your profit and loss is coming from. And then I'll just minimize it again, but we had theta that we should have had for this 3 days. We should have received, what did it say, $177? Yeah, we should have received $177 in theta, but that's if everything stayed at the same price. And it looks like slope was one too. So slope is here. Let's take a look at slope here. Let me just look at something. Okay, yeah. So we're short some calls. So okay, short straddle. So the slope is, and we'll go look at the option chain to explain what slope is. So slope is how steep this market, how steep these skews are. So for example, if these happen to be actually, they might look a little bit steep over here, but this is not really where we measure it. We measure more around the money, like around here. So this steepness factor, if can sometimes, people, this is probably the most overlooked way that you should think about your position values. Like if that changes, what's going to happen to your P&L, right? So that's pretty shallow there. Let's see in the trade builder. We'll pull up slope, and we'll see what actually happened to slope here. So slope came down quite a bit from a high number. This is actually really steep, Tyler. We've been watching slope for a while. I have a theory that slope has overall very much flattened out since zero TTEs came into existence. That's a longer probably discussion, but this is getting really steep, and so those, that has come down quite a bit, and we were, we were short, more close, premium laden puts, so we should have made money there, but that's we should have made money on the put or the slope coming down, but we didn't because of, again, the delta moved against us so much. But if we would have had that kind of isolated, like we like to talk about isolating your alpha, if we maybe the trade that we'll do today is to bet on the slope continuing to come down, but we'll isolate that by being flat deltas and flat as many other things as we can. Does that make sense so far?
Yeah, we talk a lot about isolating our alpha, especially when it comes to things like slope trades, volatility trades. It's very important to do that.
All right, cool. All right, so do you think we should go on to a trade now? Is it time?
Yeah, let's do a trade.
All right, we'll do SPX.
We typically start with the stock scan for this stuff, right?
Right, but this is a little different here because I'm going to be looking at the slope. So I want to find, one of the steepest slopes. So you could see how slope, is this right here. This row is slope. So, and if you go out 6.6, 6.9, 7, so you're kind of going, okay, it's getting steeper as we go out. So we might want to find something that's closer in, that's still pretty steep. So there's the first 8. Okay, so it goes from 6.9 to 7.1 to 7.4. So let's look at NOV. Let's look at this one right here. Since that's a big jump, 0.3, and then it goes down. So let's look at NOV 29th. And so what we're going to want to do is we're going to want to so we're going to sell puts. So we're selling a lower strike and buy, and then we're going to be buying calls, so to speak. But that's going to, if we did that, we'd have a ton of deltas. So we don't want to do the deltas. So we probably just want to do some type of a like a spread butterfly type thing. So what we'll do is we will, so we're going to sell a lower strike because that's where the slope gets steep. So we're going to sell one of these, so 58.30, and then we're going to now buy a couple 59.25. So that gives us a lot of slope, but now we're still long a lot of premium. So then we want to come out. I should have done the 30s. That would have been easier to do. So that's 100-point wide. And so, now we'll go to 60-30s and sell one of those. So we've got this long butterfly. that is mostly going to be short skew. You see how I did that? So the body of it, it's is still you're kind of the biggest part is this short call, long call here. Could have probably gone deeper, but this still should react to slope pretty well. So and so the theoretical value is 16, and so let's see. Did I do that? 58, 30, 60, 30. Yep. All right. So let's give them, so 1638. So we're only trying to get 1615. So that should be, that should be plenty. 1630. Maybe we'll give them we'll take a little bit less. So we'll go down to 1625 and we'll force that. And that'll be our butterfly for the trade for today.
Awesome. Yeah. So isolating that slope.
Yep. And you can see that the theta is not that, there's not a huge delta. The theta is not crazy. There's a bit of vega, but other than that, this is a trade that should take advantage of that slope coming in.
Great. Yeah, it's I think that was a good show. We did another slope trade, and yeah, we looked at the theoretical edges and just how important they are in valuing your portfolio, and the strategies for doing that. So yeah, thank you, Matt.
Yeah.
Again, when we started rolling out live data a few weeks ago, so you guys can trade all the stuff in Matt's positions and portfolio as all live prices. So you guys can get live prices in your dashboard. So you can trade through Tradier and several other brokers on the platform, on the ORATS platform, which is really neat.
Yeah, and I should also add to that, you don't have to get the data from your brokers. You don't have to have any of those agreements, although you might have those already. But this is a separate. We're a separate from brokerage live data. We have our own ORATS live data now, so it's a big move for us. You've done a great job on it, Tyler. There's a lot that goes into that, and it's nice to be able to offer that to our clients.
Yeah, so yeah, be on the lookout for some really cool stuff coming out from us with our data and all of our indicators and trading capabilities. We're upgrading them. So yeah, make sure to subscribe soon. Thank you, Trader, for hosting us again, and we'll see you guys again next week.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.